Pankaj Murarka is with us now, CEO and CIO at Renaissance Investment Managers. Pankaj, good morning. Great to have you with us here. Thank you for your time. Appreciate it. So we've been through a lot of volatility over the last 48 hours, maybe a little bit more. Started last week, and of course yesterday was a bit all over the place. What is your own sense as someone who's seen markets a long time, Pankaj? There will be more volatility. I think that is a given and all of that. But have global markets, to your mind, broken the sort of up and up phase at some level? So some of these growth concerns, etc., are back, especially for the largest, the US economy?
Morning, Prashant. Talking about global markets and the volatility that we've experienced over the day and a half yesterday and this morning, I think, Prashant, the fact is that there's a global reset. So far, the expectation was probably the US economy is holding very strongly and probably will have one or at max 2 rate cuts during the course of this year. Now, obviously, we've seen some weaker data points coming out of US, and the narrative has clearly changed, where the underlying assumption is now we're expecting at least 100 basis points rate cuts in US before the end of this year. And probably yesterday there were chatter about an out-of-turn Fed meeting, which just happens in very exceptional cases. Obviously, money making has been very easy globally across financial markets in the last year or so, and the trade was very crowded, meaning the yen carry trade in terms of borrowing in yen, and meaning the simplest way to play a carry trade is you borrow in the currency with zero or least borrowing cost, which yen has been, and invest in the markets which give you the highest yield, which was people were borrowing in yen and investing into Mexico, where you can have 11% yield. And when money making becomes so easy, you have so much of this crowded trade playing out, and everyone is dancing close to the gate, where everyone wants to just get out at the first sign of turbulence. And when you try to do that, that is what happens. What happened yesterday, you get a stampede. So I think probably we are here for some volatility. It will take some time to settle down, though I'm still of the view that I think recession in US is off the table. I still think that the underlying economy continues to be fairly resilient. But I think this is a pullback and probably a reset in a global macro. India relatively remains fairly stable in that sense, given our strong macroeconomic fundamentals, and we remain largely immune to the volatility globally, but there'll be rub-off effect in equities that we've seen yesterday. So I still think that globally, at least US is concerned, the bull market in US remains intact, and this is nothing but a correction in a bull market, but it couldn't sustain for some time, I would think.
Okay, this is a correction in a bull market, but it won't sustain for too long. Got it? So how do you approach the Indian markets now, Pankaj? Because if global markets continue to be in turmoil, then a lot of global facing sectors, whether it's autos, whether it's tech, whether it's steel, could maybe see some impact, right? I'm just trying to understand what's the best way to approach this market sectorally now.
Not really. My view is that talking about India, we've had a ferocious rally in the last 15 months in Indian equity markets. India has always been and continues to remain the most expensive equity market in the world. I believe once we are through this correction over the next 3-4 weeks, I believe there'll be a change in leadership in Indian equity markets. If you see through the last 15 months, the leadership has been through PSUs, engineering and capital goods and industrials, defense and railways. In most of these cases, I think, especially in case of defense, railways and industrials, while the underlying growth is strong, now stock prices are discounting or pricing in earnings 3 years out. So valuations are extremely rich in that sense. On the contrary, some of the sectors which have underperformed, which is essentially IT and technology, financials to a great extent, and consumers, I think there probably it looks like the worst is behind. As far as IT is concerned, I remain very sanguine, and I'm seeing initial signs of revival in tech spend by the top 2,000 companies or the Fortune 2,000 companies, as we talk about. So I think we'll start seeing a recovery in IT going into the second half of this year, and probably much more stronger recovery in the next year. So we remain constructive on IT, and to that extent, I think once we have a rate cuts in US, probably starting September, I think India will also have it. We should expect a rate cuts in India, if not in this calendar year, probably early into the next year, which will certainly ease some of the liquidity concerns that most of the financials have been facing on the liability side of the balance sheet. So probably I think the underperformance of financials is also done. We've been underweight financials for now almost 2 years, but I think we are close to the end of that underperformance in that sense.
Hi, Pankaj. Good morning and good to see you, Ben. Pankaj, I wanted to ask you about, this entire liquidity. We have been talking about mutual funds itself are sitting in more than 1 lakh crore of liquidity, which can support the market as well. My question to you is, but part of that would be a requirement that they normally do, right? Maybe 40,000, 30, 40,000 of it. So actually the liquidity in the market is a little bit less. What's your comment? And how much can it cushion this global weakness that we're seeing?
Well, I think in the short term, liquidity can help, but eventually markets will find their own levels in that sense, Nigel. And I think given the ferocious move that we've had in Indian equity markets over the last 18 months, and we haven't had any correction in this leg of this bull market in the last 18 months, which is very unlike a typical bull market where you get a correction once in every 12 months or so. And whatever dips we got was just for a day or so during what we got during the election day or during the budget day. So probably I think we're in the middle of a proper correction in a bull market this time around. Corrections in a bull market generally tend to last anywhere between two, 3 to 8 weeks, and at the index level you can have a pullback of 10-12%, which is a normal bull market correction tends to be. So I still think while there's cash with mutual funds, but they will probably invest more wisely and there'll be buyers on dips. Having said that, I still think this correction will play out, will run its course over the next 3 to 6 weeks.
No, got it. Correction could go on for another 6 odd weeks or so. Another news flash there. Government calls an all-party meeting at 10 o'clock to discuss the ongoing situation in Bangladesh that is coming in from Delhi with the political turmoil in the neighboring country. Pankaj, I know in terms of your ideas, you really liked SBI. And you think SBI is the one name, large cap name, which perhaps continues to look very good. I think the other one, correct me if I'm wrong, was a name that you liked very much was Birla Soft. Talk to us about prospects for both and any other new ideas you may have.
Yeah, well, we continue to own both of them, Prashant. So I still think SBI as a franchise is still underappreciated by equity markets. I think the franchise is far more solid and far more valuable than what markets are pricing in. Clearly, we've seen in an environment over the last 2 years where there is, constraints of deposits and constraints on liquidity for most of the banks. SBI still has a very robust liability franchise or deposit franchise, which is very important for a long-term growth and sustainability of any bank or a lending institution, because lending is about a leveraged business. Your ability to mobilize deposits is equally important. And I think SBI has one of the finest, we've seen the largest private sector bank, HDFC Bank, struggling with their deposit side of their balance sheet. So clearly shows that SBI is one of the most robust liability side of the balance sheet in that sense. And obviously, now with the changes they made during COVID and pre-COVID, when they went through their NPA cycle, it has a very robust lending side of the balance sheet as well. And as a bank which does 18% plus ROEs, I still think valuations are, meaning there's significant room for valuation improvement on SBI, and probably the market is underpricing the potential of the franchise in that sense. Likewise, we continue to remain positive on IT services. I continue to remain positive on IT services. My sense from talking to companies in India, and as well as listening to commentaries of global companies, there is a significant amount of pent-up IT spend which has been held back in the last 18 months or 2 years because of the rising rates in US. Now that the rate cycle in US is turning, I think all of those spends will be unleashed, or companies will start doing discretionary spend. And I think the entire, so in that context, we remain positive on the entire IT services. Amongst large caps, we have ownership across Infosys, TCS, and Tech Mahindra. We own a few mid caps and small caps as well. Birlasoft is one name which we like in the small caps. We think the company, as Birlasoft is concerned, they've gone a complete organizational reorg with the new CEO taking over about a year and a half back, and probably have a much more focused approach on business. Probably a company which is, So one of the bigger play in IT services for smaller companies, we have a handful of companies in India which are about $500 million or thereabouts of revenue. Can these companies transition to crossing the $1 billion revenue mark over the next 3 to 5 years? And we clearly see Birlasoft is one of those companies which can certainly do that in that sense. And if any company which can make that transition, crossing the $1 billion revenue threshold, probably I think there is significant value creation that's there on the table for shareholders.
Okay. One final question to you. You know, we have a lot of these new age tech companies that have now started to do very well. Zomato is a clear case in point. And this whole consumption space is picking up as well. Do you think that this is just, a cyclical story, or is it some sort of structural upcycle that we're seeing in some of these names?
I'm a perma bull on all tech companies. I think the adoption or consumption of technology by all of us as consumers is only increasing, and it will continue to increase. I think we are at a very early stage of technology adoption in India. Just think about it. If you think about the 7 of the top 10 companies in US are technology companies, and these companies are just about 25 years old. They did not exist 25 years back. I think some of the leading companies of India, amongst the top 20 companies in India, will emerge from technology sector over the next 15, 20 years. So, Sonia, I am a perma bull on tech as a sector.
Oh.
Pankaj, just in jest, perma, anything is, I mean, you've seen markets 30 years plus, and you're calling yourself, I'm surprised, perma bull on IT, but...
Yeah, on technology, certainly, yes, Prashant, because the trends I see or what I've seen having played out in US over the last 30, 40 years in the US and the world, I certainly think it's going to rule the world. Some of the leading companies of India, 20 years out, just think about it. HDFC Bank was a startup in 97 when I started my career. Today, it's the largest private sector bank of India and probably among the market cap companies in India. All I'm saying is that some of the leading companies of India over the next 20 years will emerge from technology as a sector.
Okay, well, it's always good to hear that, especially in volatile times. It's always good to meet perma bulls, right? Thanks a lot, Pankaj, for joining in. Have a great day.